Yeah. So I think on that front, if you talk to someone like Charlie Munger, he would say that, four diverse stocks carefully selected is all you need. Of course, the operative words are carefully selected. And Munger also says that if you lived in Peoria, Illinois, which if you guys have never visited Peoria, Illinois, might be a fun place to visit sometime, and you owned the Ford dealership in town, and you owned the McDonald's franchise in town, and you owned the best Class A office building in town, and the best apartment tower. Those were the four assets you owned. And you don't need to own all of them. You could own partially. You could have a 10% stake in the Ford dealership, for example. So these could be partial ownerships. He says that you would likely do extremely well over the years and live a pretty happy life as an investor. And someone looking at that from the outside would say, well, you are geographically so concentrated. So even though you're in four different industries, four different asset classes, it's all in the same geography. And that is true. But I think that if you look at most entrepreneurs, they don't even have four bets. 98% of their assets is one bet. And they don't have sleepless nights. They're pretty comfortable with single bet and a lot of the eggs in one basket. So I think that if you know what you're doing, well, if you don't know what you're doing, please index. Pretty honorable way to go through life, and you still get the power of compounding. But if you know what you're doing, then it seems like insanity to own 30 stocks or even 20 stocks. I mean, why would you put money, like Buffett would say, why would you put money into your 27th best idea instead of your third best idea? So that just makes no sense. And the idea that you would actually understand 27 businesses as well as each of them or equally is unlikely. So there's circle of competence issues, there's a depth of understanding issues that come in. And so from my point of view, the answer has been, at least in Pabrai funds, has been to go with like a 10 by 10 portfolio, 10 stocks, 10% each seems like a good medium. In my personal portfolio, sometimes I've had one stock, and sometimes, and I don't think I've had many occasions when there's been more than 4 or 5 positions. In the Dakshina Foundation, where we have, thankfully, we've now got significant assets. I think we've got north of 20 or 22, 23 million in marketable securities in Dakshina. It's invested in a very concentrated way. I mean, I don't think most of it is in more than 3 positions. And of course, in Dakshina, the idea there is that even when we do our work, the places where you spend our money, it's the exact opposite of what we do in investing. In investing, we never swing for the fences. Or in British terms, we don't go for hitting sixers. Okay, we try to get 1 run here and 1 run there. That's what we're trying to do. But in investing, in philanthropy, what you want to do is just go for sixers every time. Okay, because that's the only way you can possibly move the needle on these really tough problems is be willing to fail. And so anyway, in Dakshina, we're very willing to fail when we spend the money. And I don't think it's that risky to have 3 or 4 well-selected stocks in Dakshina, and likely to work out, and likely to help us do you more good.